You are at the dealership. You've been looking at cars for weeks. You finally found the one you want. And the finance manager slides the paperwork across the desk. $42,000 for the car. Your monthly payment options are right there. $775 a month for 60 months. And here is where they get you. Just $565 a month for 84 months. You look at your budget. $775 feels tight. But $565. That is doable. That is only $200 more than your current payment. And the finance manager is nodding, saying things like, most of our customers go with the 84-month option. And it gives you more flexibility in your budget. So you sign. You drive off the lot, feeling smart for getting the payment down to something manageable. And 7 years later, you are still making payments on a car that is worth half what you owe. And you've paid more in interest than some people's entire car costs. And you are sitting there thinking, how did I end up trapped in this? My name is Jod. And I spend way too much time thinking about how car loans have quietly become the financial decision that destroys more wealth than almost anything else in your 20s and 30s. If you are someone who is currently in a long-term car loan or thinking about getting one because the payment is affordable, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because here is the thing, 84-month car loan status 7 years there. Now the fastest growing segment of auto financing. In 2010, only 11 of new car loans were longer than 72 months. By 2023, it is over 39. Nearly 4 in 10 people are signing up for car payments that will outlast most relationships, most jobs, and probably the useful life of the car itself. And I am going to show you exactly why this is one of the worst financial decisions you can make, even though it feels smart in the moment. The monthly payment illusion. Look, let me start with the exact math that dealerships use to trap you. Because once you see it, you can't unsee it. You want to buy a $40,000 car. Let's say you put $5,000 down. You are financing $35,000 at 7 interest, which is about average right now for someone with decent credit. Here are your options. 36-month loan 3 years. Monthly payment $1,080. Total interest paid $3,880. Total cost $38,880. 60-month loan 5 years. Monthly payment $693. Total interest paid $6,580. Total cost $41,580. 84-month loan. 7 years. Monthly payment $537. Total interest paid $10,108. Total cost $45,108. Do you see what just happened? By extending your loan from 3 years to 7 years, you dropped your monthly payment by $543. That feels like winning. That feels like you are being smart about your budget. But here is what most people don't realize. You are paying an extra $6,228 in interest compared to the 5-year loan, and an extra $6,228 compared to the 3-year loan. That is $6,228 that just evaporates. Money you worked for. Gone. Because you wanted a lower monthly payment. Put another way, that 537-month payment you are celebrating, you are actually paying $642 in total cost over the life of the loan. When you factor in the interest, you just don't feel it because it is spread out. The underwater trap. Here is where it gets really interesting. And this is the part that ruins people. Cars depreciate fast. Like really fast. The average new car loses about 20 of its value the moment you drive it off the lot. After 1 year, it is lost about 30. After 3 years, it is lost about 50. So let's track what happens with that $40,000 car on a 7-year loan. Year 1, car value, $28,000, 30 depreciation. Amount you owe, $31,894. You are underwater by $3,894. Year 2, car value, $24,000, 40 depreciation. Amount you owe, $25,628. You are underwater by $1,628. Year 3, car value, 20,050 depreciation. Amount you owe, 19,083. You are finally above water, barely. But here is the thing. Most people don't keep the car for 7 years. The average car ownership is about 6 years. And even if you want to keep it longer, stuff happens. You get a new job 45 miles away and you need something with better gas mileage. Your family situation changes, and you need a bigger vehicle. The car needs a 3,500 repair and you decide it is not worth fixing. And when you try to trade it in or sell it in year 2 or 3, you are underwater. You owe more than it is worth. So you have 2 choices. 1. Come up with cash to pay off the difference, which you don't have, or you wouldn't be in a 7-year loan. 2. Roll the negative equity into your next loan. And this is how people end up owing $50,000 on a $35,000 car. They rolled over $6,000 in negative equity from their last car, and now they're even deeper underwater. According to Edmunds data, about 21% of people trading in cars in 2023 had negative equity, averaging $5,808. That is generational wealth being destroyed one car loan at a time. The psychological trap. Now, you might be thinking, okay, but I need a car to get to work. I need the payment to fit my budget. What am I supposed to do? Here is the thing. The 7-year loan isn't solving your affordability problem. It is hiding it. If you can't afford a $693 payment on a 5-year loan, you can't afford a $40,000 car. Period. The 7-year loan is just letting you pretend you can. It is like putting a 100 restaurant meal on a credit card and making minimum payments for 3 years. You are not making the meal more affordable. You are just spreading the pain out, so you don't feel it all at once. But here is what is insidious about 7-year car loans. They feel responsible. The dealership frames it as smart budgeting and financial flexibility. They make it seem like taking a longer loan is the mature, careful choice, because you are not overextending yourself with a high monthly payment. This is gaslighting. They're selling you something you can't afford, and convincing you that the method you are using to pretend you can afford it is actually responsible financial planning. Research from the National Bureau of Economic Research found that when buyers are presented with payment-focused financing options, rather than total cost options, they consistently choose vehicles that are 15 to 20% more expensive than they would if they were paying cash or thinking in total cost terms. The monthly payment frame literally makes you buy more car than you can afford, because your brain stops thinking about the total cost, the maintenance time bomb. Look, here is something that is going to happen, that nobody's warning you about. Most cars have a 36,000 reals, mile basic warranty. Some manufacturers offer 60,000 reals, mile powertrain warranties. Your 7-year loan extends well beyond any warranty protection. So here is what your payment timeline looks like. Years 1 to 3, 537-month payment. Car is under warranty. Years 4 to 5, 537-month payment. Plus you are now paying for all repairs. Years 6 to 7, 537-month payment, plus increasing repair costs as the car ages. In years 6 and 7, you are making a 537 payment on a car that is now 6 to 7 years old. You are dropping 500 on brakes, 800 on tires, 400 on a battery, 1,200 on a transmission service. Suddenly your affordable 537 payment is actually costing you 750 to 850 a month when you factor in repairs and maintenance. And here is the kicker. According to AAA, the average annual cost of owning and operating a new vehicle is about $10,728 per year, or $894 per month. That includes everything: payments, insurance, gas, maintenance, repairs. But if you are in a 7-year loan on an expensive car, you are likely spending $1,200 to $1,400 per month total by the time the loan ends. That is $14,400 to $16,800 per year. For context, that is more than the average American spends on groceries in a year. You are spending more on your car than on feeding yourself. The opportunity cost nobody calculates. Here is the part that makes me genuinely angry when I think about it. That difference between a 3-year loan and a 7-year loan isn't just about the interest you pay. It is about what you could do with the money if you weren't trapped in a payment. Let's compare two scenarios. Person A, 3-year loan, pays $1,080 a month for 36 months. Owns the car free and clear in year 4. Continues paying themselves $1,080 a month into investments for years 4 to 7. By year 7, they've invested $51,840 into index funds. Person B, 7-year loan, pays $537 a month for 84 months, still making payments through year 7. By year 7, they've invested $0. Let's assume Person A's investments grow at 7 annually over those 4 years while they're contributing. By year 7, Person A has approximately $60,200 in investments. Person B has a car worth maybe $12,000 and no investments. That is a $48,200 net worth difference from the same car purchase. Here is what most people don't realize. The 7-year car loan doesn't just cost you the interest. It costs you the opportunity to build wealth during those years when you could have been free of the payment. The cycle that never ends. Here is something that happened to someone I know. And this is the nightmare scenario. They bought a $38,000 car on a 7-year loan in 2017. Payment was $520 a month. By 2021, 4 years in, they had paid $24,960 in payments. They still owed $14,800 on the loan. The car was worth about $18,000. They decided they wanted something different. They traded it in. The dealer gave them $17,500 for it, less than market value, because dealers do that. After paying off their loan, $14,800, they had $2,700 to put toward the next car. They bought a $42,000 car, put $2,700 down, financed $39,300 at 6.94. You guessed it, 84 months. New payment, $602 a month. They went from owing 4 more years on a $38,000 car to owing 7 years on a $42,000 car. They reset the clock. And statistically, there is a decent chance they'll do it again in 2024 to 2025 before the loan is paid off. This is the cycle. 7-year loan trade-in before it is paid off. Roll over remaining balance or barely break even, take another 7-year loan on something more expensive. And suddenly you are 40 years old and you've been making car payments for 20 straight years. And you have nothing to show for it, except a depreciating asset, and a payment that never ends. A study from Experian found that in Q2 2023, the average amount financed for a new car was $40,290, with an average payment of $736, over an average term of 68 months. People are financing more for longer, at higher payments than ever before. This isn't normal. This is a crisis that nobody's calling a crisis. The insurance trap within the trap. Look, here is something that makes this even worse. When you finance a car, your lender requires full coverage insurance. You can't just carry liability. You need comprehensive and collision coverage to protect the lender's interest. On a 3-year loan, you are stuck with expensive insurance for 3 years. On a 7-year loan, you are stuck with expensive insurance for 7 years. Let's say full coverage on your financed car is $190 a month, but liability only would be $85 a month. Over 7 years, that is an extra $8,820 in insurance costs compared to liability only. So, now your total cost of that 7-year loan isn't just the $10,108 in extra interest. It is the $10,108 in interest, plus the $8,820 in additional insurance costs you are forced to carry. That is $18,928 in total extra cost from choosing the 7-year loan over paying cash or using a very short-term loan. For a $40,000 car, you are actually spending nearly $59,000 when you factor in interest and the insurance premium you are forced to carry. What you should actually do. Alright, here is exactly what you need to do. If you are currently trapped in a 7-year loan or considering one, if you are already in a 7-year loan, first, figure out if you are underwater. Check your car's value on Kelley Blue Book or Edmunds. Compare it to your loan payoff amount. If you are underwater, you need to accept that you are stuck for now, but you can start fixing it. Second, make extra principal payments whenever possible. Even an extra 50 to 100 a month toward principal will shave years off the loan and save you thousands in interest. Third, do not trade out of it early unless you are even or positive on equity. Rolling negative equity into another loan is how people end up permanently trapped. If you are considering a 7-year loan, don't. Stop. If you can't afford the payment on a 3 to 4-year loan, you can't afford the car. Instead, do this. Step 1. Calculate what you can truly afford. Take your monthly budget. Figure out what you can comfortably put toward a car payment without sacrificing retirement savings or emergency fund contributions. Let's say it is $400 a month. At 7% interest on a 48-month loan. That means you can afford to finance about $16,800. Step 2. Add your down payment. If you can put down $3,000 to $5,000, you can now afford a $19,800 to $21,800 car. Step 3. Buy that car, even if it is boring. Yes, it is a 4-year-old Honda Civic, instead of a new SUV. Yes, it doesn't have heated seats and a sunroof, but you know what it has. A payment that ends in 4 years instead of 7. And more importantly, it is a car you can actually afford. Step 4. Keep the car for 10 years. Here is the thing. If you buy a reliable $20,000 car on a 4-year loan and keep it for 10 years, you have 6 years of no car payment. If you invest that $400 a month, you are not paying in a car payment during those 6 years. At 7 returns, you'll have $34,800. That is enough to buy your next car in cash. And then you never have a car payment again. The math that changes everything. Let me show you something that should fundamentally change how you think about cars. The average American spends $894 a month on car ownership, payment, insurance, gas, maintenance. Over a 40-year working life, that is $429,120. But what if you bought reliable used cars in cash and kept that same $894-month budget, but invested the difference? Let's say you buy a $12,000 car every 8 years, 5 cars over 40 years. That is $60,000 in cars. You still spend $200 a month on insurance, cheaper because you are not financing. $180 a month on gas, and $100 a month on maintenance. That is $480 a month, or $230,400 over 40 years. Total spent on cars and car costs, $290,400. The average person spending $894 a month, they spend $429,120. The difference, $138,720. But here is where it gets interesting. If you invested that $414-month difference, $894 to $480 for 40 years at 7 returns, you'd have $1,048,000. Let me say that again. The difference between financing cars your whole life versus buying used cars in cash and investing, the difference is over $1 million. $1 million in retirement from your car decisions. The identity trap. Look, here is the real reason people sign up for 7-year loans. And it is not about math. We've been conditioned to believe that the car we drive says something about who we are. That our car is a reflection of our success, our status, our worth. So when you are making $75,000 a year, and you think you are supposed to drive a $40,000 car, because that is what successful people drive, you'll sign up for a 7-year loan to make it work. But here is the thing. The actual wealthy people, the ones with $2 million, $5 million, $10 million in net worth, they're not driving cars that cost more than half their annual income. They're driving paid off cars that represent maybe 5 to 10 of their annual income, if that. The people driving expensive cars on long-term loans are the people pretending to be wealthy. The people actually building wealth are invisible because their wealth is in assets that compound, not depreciating vehicles in their driveway. Your car doesn't make you successful. It either helps you build wealth, or it prevents you from building wealth. That is the only identity that matters. Look, the 7-year car loan is designed to keep you in debt forever. It is designed to keep you making payments while your car depreciates faster than your loan balance decreases. It is designed to trap you in a cycle of negative equity and perpetual payments, and the finance industry loves it because you are a customer for life. You never pay off the car. You just trade it in for another long-term loan. You are a subscription service for car payments, but you can opt out. You can buy less car. You can keep cars longer. You can break the cycle. And I know, it is not sexy. I know a 5-year-old Camry doesn't feel as good as a brand new SUV. But you know what feels better than a new car? Having $400,000 in your investment account at age 50 because you didn't spend it all on depreciating vehicles. So if you are currently considering a 7-year loan, please don't. Buy less car. If you are currently in one, start paying extra toward principal, and commit to never doing it again. Your future self, the one who is financially free will. Thank you. If this changed how you think about car loans, and you want more content that breaks down the financial traps that keep people broke, make sure you are subscribed. I'll see you in the next one.